What should I make of the fact that the first two games of the Stanley Cup Finals, both the winners and of course both the losing goalies, have all had sub 900 save percentage?
Maybe goaltending doesn't matter as much as Oilers fans seem to think.
That's my inclination. That's obviously, having that hometown bias lens view of things. Yeah, I do think that. So, cool down, fans, supporters. We'll see what happens on the off season. But being a goalie, and of course, I'm trying to relate this to like portfolio development and construction, and say, do you absolutely need to have a Vasilevsky or a Hellebuck? Because sometimes they don't perform well, even though they may be considered the best ones. But anyway, I haven't quite formulated that yet. But as I saw the results of the first two games of the final, it's like, yeah, there's something there. I think I can. I don't know why nobody else has brought it up, but
I think it comes down to a goalie's not getting peppered with pucks all game the way Cujo used to in the 90s when the Oilers had really no defense.
Yeah. Or Hasek.
But maybe these teams that are in the finals are very good for a reason. They have very good defense that keeps most of the shots out.
Except for the shots that do go through perhaps? Or the unlucky ones?
Yeah, they're high quality shots, and a higher percentage of those go in, but there's far fewer of them. That's just it. That's how they win.
This reminds me of, the classic, the bias where the airplane and the bullet holes, right? And it's like, what am I supposed to analyze? Do I analyze the places of the plane that have no bullet holes, or the ones that came back and had all the bullet holes but were able to come back, right? Yep. So anyway, I'm going to have to tie this in, but that's what I was thinking about this week.
Yeah, so I don't know if we can segue that into our topic for today. We kind of debated talking about this a couple of weeks back, right? Like, it's been hard to find time to record another episode. And that can be proven by the fact that this is episode 3 and it's already June. So we're kind of becoming like the Grand Tour. You watch that show, the Grand Tour on Amazon, where they used to have a whole season of episodes, like 12 episodes or whatever. Now it's like every few months they come up with an episode, but they're high quality episodes. So, we wanted to talk about, and I think this is kind of what you were getting at originally, the democratization of investing and how maybe in some ways it's gone too far.
I think it's still in development, like a lot of things. It's nascent, relatively speaking. As I put down my phone, I'll pick it back up again for those who might be watching this on a video stream, is that this thing in my hand is more powerful than most computers ever were previous to its inception. And with that, comes responsibility, but also negatives, right? There's pros and cons. And so, yes, I can be in contact with people around the world if I choose to. But also, there's a lot of distractions, as we've probably heard, through social media, through just touching the phone all the time and staring at this thing, trying to tell my kids not to do too much screen time, and I'm looking at my own phone as well, hypocritically. And of course, all those things, the other thing that comes into play is, investment platforms, investment options. I'm going to kind of intertwine this probably as well thematically about like online sports gambling. We're just talking about hockey and how it permeates all sports media now, right? Online gambling, prediction markets as well. Those are going to rear its head in Canada very, very shortly. They've already a big thing in the United States. And so it's not going away. And I guess, we need to not necessarily address it, but recognize it, that like democratization of all sorts of stuff, of information, can be very powerful, but also it can be a hindrance in a lot of aspects too.
Well, democratization can always go too far. I mean, we've seen that through history. Maybe some places like California where they have a referendum on everything. If you try to involve
Alberta
people
too,
in every single decision. I mean, you cannot have every decision go to a democratic vote with a majority rule. So when it comes to investing, maybe in the same vein, too much democratization maybe is not the greatest. So kind of what we're getting at here with this is, when I think democratization of investing, I've been following this for however long I've been in the industry. I started at a bank where people came in to see me. buy some mutual funds. They got some very basic advice at the bank, and the funds
Yep.
were fairly high costing, as we know, usually more than 2% MERs. And if someone wanted to go to private wealth, some people with a bunch of letters after their names, real professional people in the wealth management industry, they were usually told, you don't have enough to invest with us or something like that. So democratization, what's happened in the last, I don't know, like 15 years now, a couple things. One, it's become easier and easier for people to own entire portfolios with just owning an ETF, a single ETF in some cases.
Yep.
It's become easy to have a managed portfolio through a robo-advisor at a relatively decent fee, in the neighborhood of 0.2 to 0.5% plus the underlying cost of the funds. Much better than the bank option where you're basically putting your money into a big mishmash of funds for 2 point something percent. And a lot of these online providers have offered added extra services like banking and savings accounts, and it's mostly good stuff. It opens up, it basically facilitates the average person, regardless of their net worth, to invest their money, get invested. We always talk about that for young people, to get invested as soon as they can, and even get some potential retirement planning in a way. They often have basic retirement projection tools on their websites, things like that.
Yeah.
So that's all good. I mean, I can't pick a bone about any of that, really, right?
No, not necessarily. Underlying, I think, to your point, I mean, technology has provided access and capabilities of all sorts of things, right? And in the financial investment world, similarly, right? I think it can overreach in certain areas, or we're just starting to learn what some constraints may or may not be necessary, both behaviorally and actually maybe perhaps legally and other aspects as well.
We've gone from really an environment where if someone wanted to buy a stock, they'd have to phone up a stockbroker or whatever and pay hundreds of dollars, thousands of dollars sometimes for the ability to purchase a stock, to being able to open a discount brokerage either with their bank or online and do so for, initially back in the 90s, it was usually about $30. Now it's either $10 or potentially free. And then likewise on the managed money side of things, it used to be the only way to buy mutual funds with a mutual fund was the mutual fund dealer. You'd be paying an upfront commission or be stuck in a deferred sales charge schedule. And now you can just basically go and buy that on, again, a discount brokerage, buy an ETF, much lower costing. So it's super, super easy for people to get into investing. And what you're getting at is the other thing that's being made easier, and this is where Jack Bogle is probably rolling in his grave, is it's so much easier to trade, Jack Bogle, the founder of Vanguard, was originally very much an opponent of ETFs on the basis that an ETF allowed someone to buy the market, great, but it also allowed them to trade it. And Vanguard started out traditionally with index mutual funds, which were harder to trade actively. So Bogle liked that, liked to make a way for people to get their money invested in the overall market cheaply, but he didn't like offering them a way to be able to buy, sell, buy, sell.
A little friction.
There has to be some friction. We talked about it before. We brought up that example many times of how old fidelity accounts of deceased clients they found had the best performance because nobody traded them. And the truth is, when there were deferred sales charges and they caused a friction, keeping people from constantly buying and selling, it did actually lead to some better outcomes. Not that, again, I've mentioned it before, I'm not a proponent of that, but it did have that positive outcome
results
among negative outcomes. So today it is so easy to trade on your phone. A lot of these online offerings are making it easier and easier. We've talked about the gamification, one particular company in the States that has been big on that, and they seem to be expanding to Canada now, too. And the big Canadian company, we won't name any names here, but people know who we're talking about probably, that are kind of following in their footsteps. Offering the cheap trades, getting into things like prediction markets, like you mentioned, various ways to trade cryptocurrency. So, people come to these companies probably with the good intention of being able to build a portfolio for the retirement, using the retirement tool, building that either balanced or aggressive or whatever portfolio, having to be nice, low cost, adding money regularly. And then they're
Yeah.
constantly being distracted by these shiny objects. Would you like to trade crypto? Would you like to put some money into this private investment fund that we offer,
Yep.
which
Yep.
happens to have some affiliations with the same parent company that also owns
Sure.
different private companies?
Yeah.
And now they're talking about this being democratization, that, you know, these private investments, which used to only be available to the royal family of Liechtenstein, now you can buy that too on your online investing platform. That's democracy. No
Yeah.
longer just for them, it's for us.
Yeah. Yeah. My son's not anywhere near driving age or learning permit age yet, but I don't suspect many parents would give their, you know, newly graduated or license graduated child, a 16-year-old, the keys to a Ferrari, for example. Right? Yeah, it drives. Yeah, the option's there. Right? They've apparently got a license. They can drive this vehicle, but does it match? Right? Is it the right tool, in a sense, right, for that situation? Or would they be better off in a, whatever the equivalent of a Corolla is these days, right?
I think it's still a
They need a
Corolla.
Cybertruck. Still a Corolla? A Corolla's a Corolla?
It's always
Those
the example.
Toyotas
It's always
last
the
forever.
example that's brought up when you're talking about a basic, modest car, a Toyota Corolla.
But
You
good
can't go
on
wrong
gas
with
and
that.
lasts forever, right? Yeah. And I guess there's a reason why. But the tool, is it appropriate, right? Yeah, it's accessible, right? But is it actually the right decision, or is it the one that you really need? The other side of the coin of options is that sometimes there's too many. You can look at the grocery store. You can look at anything where there's a plethora of options, and sometimes they fit and sometimes they don't. But the option's there, and sometimes it has to do with marketing. Does every individual need to trade options? By a touch of their phone. Does every client or investor or individual need to invest in illiquid private credit or equity? Right? These are conversations you need to have with somebody to see if it actually does match, and it may be very appropriate. Even structured notes, structured products, right? They exist and they're incredibly popular for a reason. But is it necessary for everyone? I guess, right? And I think a lot of people
the
are
answer
trying
is
to
no.
blend it in. The answer is no. Maybe
The answer
is
for
yeah.
an average person, especially a younger person, retail investor, not highly sophisticated. And again, it kind of gets down to these platforms. They're probably not making a ton of profit just offering really cheap ETF trades and stock trades, just offering their portfolios, where they're dealing with clients that are in the relatively small range, tens of thousands, and offering them the service at a fraction of what we do. And we know how hard it is for our business to be profitable at smaller volumes. But anyways, they're not making enough money doing those basics, so they have to bring in these various things. You mentioned a couple of them, like prediction markets. There's a great opportunity. It's very opaque. It's a great way for them to drive revenues. And of course, crypto, which has been hot for years now. Some of the latest things I saw, one of them is offering a way to bid on IPOs. So we're hearing about SpaceX and Anthropic and stuff in the news all the time. And now you too can invest in these things, which for us advisors, we get these questions from clients. How do I get into SpaceX? And usually the answer is kind of, it's a little bit late. There were ways to get into SpaceX many years ago as private investors. And unfortunately, that was not available to the average investor. That's a sad truth. But today, what's being offered when it comes to these private equity investments going public, you, the retail investor, are the liquidity for decades of private investment rounds that went into this. The private investors are going to make money on Anthropic, SpaceX, whatever. You, the retail investor buying the IPO, you're not going to make a bunch of money on this like they will. You're buying at a massive valuation. Maybe if something IPOs at $1 trillion, it goes to 5 trillion, who knows? But just because people in the past made a bunch of money on it, just because it's talked about a lot, it doesn't mean it's going to keep going the way it has.
Yeah.
The unfortunate thing I'm kind of getting at too, when it comes to these types of stocks, in the 90s, we could get into Amazon, Yahoo, whatever. When they IPO'd,
Yeah.
that was probably when when those types of companies were more democratized, I guess when the markets were more democratized for innovative companies, because back then there wasn't this massive amount of private equity sloshing around trying to buy these companies, keeping them
Yeah.
private for many years. These companies had to go public in order to raise money. So the average investor got a chance to participate. You could buy Amazon at a ridiculously low valuation back then and participate in all those years of growth. Nowadays, you're not going to get the same type of outcome when you're buying this company that's been around for a decade already, perhaps longer with SpaceX, I'm not
Mm-hmm.
sure. And it's only now going IPO. It's only going IPO now because those private investors want to finally realize their gains.
Yeah. And so a host of items there to consider. Uh, to your point, the route for these companies back a decade or two ago was to go to the public markets to raise capital so that they could build off of in their investment thesis or their growth projections or opportunities. And so now, because of this large amount of private equity, private credit, private market money that is investing in these companies, they're staying private for longer. So those opportunities that you talked about to get, Amazon or Google or any of these famous names at, you know, a $20 billion valuation, a $10 billion valuation. Now they're staying private for longer. They're not going through, if you know the vernacular, series A, B, and C type of funding rounds. And they're going through A, B, C, D, all through H, I,
Yep.
J. They're going through the entire alphabet. And so, yeah, there's something to be said about like a market is a market. So if you're buying something or the opportunity is there to buy something, well, then somebody is selling it. So conceptually try to understand why they're looking to sell it. Maybe it's just to reduce their overexposure or their large position. Maybe it is, in some senses, an exit strategy, right, for them. And to your point, if that analogy of looking at the poker table, if you don't see the patsy or the sucker on the table, it's probably
It's
you,
you.
or not, right? But that
Yep.
comes to mind, right? But again, to a certain extent, that argument there partially justifies the idea of having some access for the retail investor to get into what is right now private equity, which is not necessarily available to them, but that option, those investable opportunities, the underlying investment opportunities were available to them, to us 20 years ago or 10 years ago or whatever, right? So in order to get those opportunities, they have to go into these vehicles now. Is that justify all of it? Does everybody need to get into private equity? Not necessarily, just as much as every person didn't necessarily have to buy into every IPO that came out 20 years ago, right?
And we've talked about this before too, like all these
Mm-hmm.
private investments. I think back in the fall after I went to that conference, I talked about just how much they're being sold to us advisors. How this is the thing we have to have in our clients' accounts. This is what the pension funds and the endowments are doing. So, your clients need
Yes.
to be in these investments too. That's again part of that democratization push as well. When, like
Yeah.
you said, it's really kind of in a way exit liquidity for those endowments and pension funds, getting more money coming in to be able to buy the paper, getting that retail money into it. But yeah, ultimately, what we're kind of touching on with this podcast is how it's these direct to consumer online platforms, online investing platforms. I'm not sure how to describe them because one used to be
Mm-hmm.
exclusively a robo advisor, then it became a discount brokerage as well. But just how they're going into all these different things, selling the shiny objects, again, democratizing these additional types of assets. But is it really good for the investing public at large when probably they'd be best off not being distracted by all these shiny objects and just putting their head down, investing regularly monthly into a simple index portfolio.
I think I found that also, how the
It's getting dark
how
out there.
it's good.
Sorry.
It's storming. It's gonna storm.
Yeah.
This
Yeah.
portends the future. Although the markets today were pretty stormy, but as an aside, pension plans and endowments have very different expectations,
Exactly. Yeah.
and perhaps most importantly, if not importantly, most salient is that they have different time frames. We do have long time frames. You, I, clients, individuals, we think in decades. Some of these endowments and pension plans think in like century, decades plus. They don't think about
Mm-hmm.
3 months. They don't think about 3 years till retirement. They're thinking about your children's 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 retirement, right? The people behind CPP aren't necessarily investing, although they are, in some senses for the current retirees who are receiving CPP money or pensionable benefits, but it's also for the future sustainability of people who are Canadians, 100 years from now. And so their time frame is maybe very suitable for certain types of investments, i.e., private equity, infrastructure, illiquid assets, whatever term you'd like to use. And although people say are aligned and they like the idea, and I'm in it for the long run, you get a downturn or you get a requirement or a need to withdraw money or for some liquidity, and then that plan just gets thrown out the window. And like, I want my money now. And it's like, you didn't sign up for that. You said you were, right?
That's kind of a little bit the cause of some of the consternation in the private everything market these days when it comes to gating.
Certainly.
The whole gating thing, you can say it's a feature, right?
It's a feature. It's not a bug.
Well,
it's supposed to be a feature.
It is a feature because you don't want to run on the banks. We always, kind of hear these stories of running on the banks in the 1920s or 30s. A bunch of people are worried about money in the bank, so they all go to pull out their money, but they just make the problem worse. So these types of investments, they're the underlying investments of such funds are illiquid. So you cannot have a model where everyone can just take their money out at once because they can't sell the underlying. With a mutual fund that owns public stocks in the open market, perfectly fine. Everyone can take their money out. The fund can sell all the stocks the next day or that day as they're able to take the money out that day. But if it's real estate, you can't sell it all at once. If it is some kind of a private equity, private debt instrument, you can't just liquidate that right away. So they get gated. But the reason why this whole thing happened, why a lot of funds in Canada in particular got gated over the last year, is because all of this retail money flowed into such investments. Again, because we're democratizing it. But these are people who don't have the type of time horizons as the traditional investors in private investments, those pension funds and endowments. CPP can buy an airport in Europe and hold it forever, pretty much. A retail investor in a private fund can't just buy that and then get their money out if they need the money for, whether it's just something benign like they need it for their retirement cash flow, or because they get spooked because they heard whatever other fund got gated. So let's get our money out of this one. There's an incompatibility there. And the market is figuring this out. And probably going forward, those evergreen private funds are not going to be as evergreen in the future, I think, just because they're finding that you just can't make that accessible, that liquid.
So part of me, one other point to think about is that, no one bemoans Costco per se necessarily, right? But Costco doesn't make any money off of their hot dogs. And they don't make money off that rotisserie roast chicken either. And I think everybody understands. I think everyone understands the concept of a loss leader. And then also, and so then if you have very cheap or no fee services or offerings, they need to make up, as a corporation or as a business, even you need to kind of keep the lights on. There's going to be other ways where they're going to look to extract some value out when they sell you that hot dog. And maybe having too many choices isn't necessarily the best thing. And so maybe these products, I will say though, like whether it's a structured product or whether a private mandate that expects you to have, no withdrawals for 10 years at a minimum sort of idea, or under duress of severe penalty, like 5% or whatever the heck you want to call it, right? Is that they were almost engineered to make you maintain a certain behavior. And when you have less shackles, or I'm calling shackles, but limits around you, those constraints and those conditions, you find yourself doing things like zero dated options, or buying in and out of something, or the next hot IPO, or trying to get into the next hot IPO, or trying to buy, even bet on a game in the third period, right? And then 5 minutes before the end and into OT, right? Some constraints I think are good for people so you got to accept them. I don't think that the total democratization, I hate to use because I think we all, which was it Churchill? Democracy is the best, system. I'm paraphrasing.
It's the worst system except for all the others.
It's the worst except for all the others. Yeah. And it's like, well, we're working with this. We're dealing with this right now. The reality is that more and more, we're going to have prediction markets in Canada instantly, very soon. There's going to be more and more intertwining of what some people used to call like the degenerate economy, right? And there's this intersection of technology, accessibility, financialization, gambling, all of that is just kind of tied into things. And why should it be limited to this cohort of people? I want to be able to do that, right? I don't want to be part of the permanent underclass. And if I can't buy a home and I can't inherit something in downtown Toronto or downtown San Francisco that my parents bought 30 years ago, then I got to find another way of doing it. And it's through zero dated options on, SpaceX call optionality or whatever you want to design. So we have to work
that's
with
getting
this.
into an entirely different and different problem.
Yeah.
But yeah, so what can we take away from this? So I was kind of thinking of an analogy myself. I used to be really into computer games, video games, like role playing games. I don't know if you ever played Dragon Age. Those
No, I
games,
did
that
not.
series. So
StarCraft.
the first two games in that series, where they were great games and they were a bit more linear, you kind of followed a path through the game. Even if you were on an overall map where you can go anywhere, there would be a clear
There was a goal
path to follow.
Yeah.
You do this quest, you go here. The third game in the series, I could never really get into
Open world.
because it was way too open world. Yeah. Same
Yeah.
thing with the some of those later Elder Scroll games. I could not get into them because they were just way too open world. There were too many things to do, and I just could not. Yeah, I could try doing a lot of stuff, but I could not get into the game. Exactly. Yeah, GTA. I tried playing that. So we're in this world now, investing wise, where we're not in we don't have a linear path anymore. It's a less linear path. It's not go to the bank and open an RSP, start saving, go into a balanced growth, aggressive growth, whatever. There are just so many more options. We have to be able to, I guess, police ourselves a little bit. Make sure, really, I mean, I'm talking my book here, have a financial plan before you invest. Don't just look at the wide world of investing and say, hey, that's a shiny object, I'll take that. Like being a kid in a candy store. It's like shopping, really. I mean, okay, we're going to do more analogies. Grocery store. You don't just walk into a grocery store without a list and then just buy the stuff that looks really tasty on the ends of the aisles where the more expensive and less healthy stuff usually is. But you got to go in there with a plan if you want to at least shop both economically as well as healthily. We have to just understand the world we're in and be able to filter out a lot of that stuff, because a lot of the stuff, it's not for us.
It's not for us all the time, I think, also, right? Men cannot live on bread alone, right? I cannot just have, brown rice and beans. There's things to enjoy, right? If I want to go watch a hockey game and just gorge on a bag of chips and not, and salsa dip or guac, right? Then,
The chips
every
doesn't
now
get you
and
to
then.
your goal, though.
But I think if you have a core basis, and I think this is something where we will fundamentally agree upon, if we cover 90% or 95 or whatever portion of it, and we have a good diet and good behavior, good habits, then you can have a little bit of a cheat day. You can have a little bit of a fun trading account that will scratch that itch or that cocktail party banter, the water cooler conversation, the locker room talk, right? But you're also getting these other behavioral psychological benefits that are coming out of it. So you can go to your cocktail conversation, a party, and say, hey, guess what? I got into the IPO or man, memory stocks these days, Micron, look what, maybe I should go to Korea these days, blah, blah, blah. You want to buy that, bag of chips or buy that steak or that extra fat, whatever, right? Have that plan in place. Have all those other things. Obviously, it's a consumer-based, like when you go to the grocery store, you have the choice. And now in the investment world, like I said, we have a plethora of choices. There's more ETFs now than their individual stocks. Why do these things exist? It's because they're trying to scratch and see if something sticks, just as much as any other product, consumer product out there, right?
We can't tell these companies to stop offering this stuff. We can't tell them to stop offering options as well as, choices, not just option trading, but choices.
Yeah.
Or tell them they can't go into these ventures where they can make potentially more money. But as a consumer, we need to understand it. Again, we invest in a free market environment for investments and wealth management. Buyer beware, caveat emptor, and figure out what's right for you, and understand that not everything that's out there is right for you. The issue with a lot of these companies that are offering these things now, they got their start offering index funds for $1, really did good stuff for the investor. everything they offer is not as altruistic and good.
That may have never been the plan to begin with. I think the conversations are there. Like, I mean, again, democratization, freedom of access, optionality, these choices that we have, right? Like, they're fundamentally, I think we can all appreciate it's a good thing, right? You want to have that transparency. You want to be able to know that there's something that fits me. If we're talking, bespoke type investment or bespoke type planning, then maybe there's something that fits me incrementally a little bit better than Mr. Smith down the street, right? And that can be worth the conversation. That is certainly worth the exploration. But don't say that everything you have to have everything, right? Or I got to pick the next shiny thing, right? And again, there's going to be even more choice down the road. And building off of that, I think makes for a very engaging conversation. Certainly makes for good, I think, podcast material. But know that a lot of it is probably, let's say, fluff, but extraneous to the core requirements or what you need as a basis for a financial plan or for a good balanced portfolio or one that has appropriate allocations for you.
So I've never recorded a podcast during a storm like this before. It's it's really coming down out there. I don't know if you can tell on screen there or if you heard any of the thunder.
It got darker. It's very Shakespearean.
It got pretty dark out there.
What happens in Shakespeare when it starts raining? Bad things. So it's an omen, portending something, right? So it is nature's way of saying that, yes, we need to recognize that not all is bright and shiny in the world. May I ask you a question then? Now that we've gone through all some of this dialogue, is there something that's out there that's a little esoteric that actually may be interesting to you? Or completely on the other side, completely off-putting?
The prediction markets and overall, it's pure gambling.
Okay.
As completely off-putting. I mean, esoteric.
Or just in one of these new things, not your classic, DFA type, good, solid, value-based, analytical minded.
There is a case to be made for private markets, and the case that's always brought up by those people who are selling the idea of buying into the private equity markets is that the public markets are shrinking, that they're just not as relevant. Obviously, and this is not talking about what these platforms are offering in terms of getting into the IPO for SpaceX, but if there is a more democratized version of getting into those types of companies 10 years ago, that is something. It gives access to an asset class that does represent part of the economy. And even when we're thinking about my sort of style of, DFA investing, we want to own the total market. We're limited to publicly traded securities. So to achieve access to the full market, if we're only looking at public equities, maybe we're not, and maybe there's a reason to have access, and everyone should have access to some form of private equity. Now, I don't know if everyone gets access, doesn't that push the prices up to the point where they basically are just as overvalued as the public markets, and there isn't really much of an advantage anyways, only greater opacity. So, I mean, that is something where that's some real thunder coming there now.
I don't hear it, so you're okay, but it's bothering
so I'm
you.
making it to the mic here.
It's an interesting point. Because if you take a step back, there's a lot of factoids, the politicians and the economists will say that, the biggest driver of the economy largely, are small, businesses, mom and pop entrepreneurs, that sort of idea. Yes, there's a lot of, the public market is huge, but the private market is even larger, right? It's like every shop down the street, every sort of idea is private, right? It's massive. And probably anecdotally, some of the wealthiest people out there, quite often those are business people that have run and built and developed something that more or less you can consider to be private, their own business, right? And then they need it. And then those things are incredible wealth generators for them. Why can't my neighbor get invested in this in some form too, I guess, right? So it does change the perspective of that. Interesting point, though. One example of something that was new this year that I found some traction on was I wanted to be able to get some exposure to some South Korean companies, and in particular in the memory space. I wanted to buy into the duopoly or the 2/3 of the oligopoly that is in memory, it's not easy to invest for, Joe Public. But then an ETF came out and that offered a wrapper, a package to be able to be invested in those offshore foreign companies. And I wanted to buy, have some exposure to the largest ones and not just the American one. So a package, an opportunity. There was an ETF that came, and I invested in that because I wanted that exposure. And then I may turn that off or change that exposure in due time once the accessibility of those companies become better in North America. But that was something that in an ETF that didn't exist 3 months ago, and all of a sudden became available. And so those are things where like, okay, I can kind of see something like that. There's obviously an MER associated with that ETF, but I was happily to pay that or understand the cost of that because it provided an opportunity that wasn't necessarily available or as easily accessible previously.
Well, and you got in fairly early to that, probably when that ETF incepted, and that ETF's been talked about so much in the last couple of every podcast. Even my German podcast I listen to, they're talking about that same ETF, and again, it's a shiny object that a lot of people are going into now. Now that they've seen these massive appreciation of these particular stocks in the past, did you check how much it's down today?
Oh yeah, don't worry. That's why it's rating.
15% in one day. And it's an ETF that is largely invested in two companies, right?
Two overseas, right, two in South Korea, and one in North America, United States. Three holdings comprise basically 75% of this one ETF. It's not for everyone, trust me, right? But that 15% downside today is a little more palatable when it's up, like you said, more 100% in the month, even with the downturn, with the correction today. Mm-hmm. So, but for someone who bought in, last week or this past week, it's the journey hasn't been that great either, right? But there was an intention, there's a purpose behind it. My expectation is that one of those underlying companies is going to be much more accessible in North America through an ADR, an American Depository Receipt. And then that was my thesis. And that's probably when I'll probably be, getting out of the ETF or not using the ETF to nearly the same degree. So, aside from any, pushback on that or thoughts?
No, I gave you my thoughts there.
Okay. All right.
Well, I mean, really, it's that type of an investment is not going to help a young person saving for their retirement or for whatever goal get to their goal. It is maybe a nice thing to have at the peripheries of your portfolio. And if you're invested in a real total market portfolio all over the world, you've got those in the portfolio. My portfolios I manage, which are very diversified across the world, eventually have those two companies and Taiwan Semiconductor as probably top 10 holdings because they appear in the emerging market sleeve as well as in the international equity sleeve because they're so big. So do you really need to kind of go all in on something like that? I don't know. It's nice to see those types of returns, but it's also in the greater scheme of a 20-year retirement plan. It's not vital, I'll say.
No.
Anyway,
it's a sliver of the overall portfolio. Yeah.
Coming up on the hour, and I kind of just want to look out my window and watch the storm now. So as it blows through, and we'll leave it at that.
Storm
and
chasing.
Of course, go Canada, where World Cup is coming up. And
I'm excited.
Canada Day, and I'll be leaving this flag up till October. Any views discussed in this podcast are those of the presenters or any guests and not necessarily those of Canaccord Genuity Corp. Statements expressed herein are not intended to provide tax, legal, or financial advice, and under no circumstances should be construed as a solicitation to act as a securities broker or dealer in any jurisdiction. All views expressed are intended for general circulation only and do not have any regard to the specific investment objectives, financial circumstances, or general needs of any individual, organization, or institution. Investing in equities is not guaranteed, values change frequently, and past performance is not an indicator of future performance. Investors cannot invest directly in an index. Index returns do not reflect any fees, expenses, or sales charges. Please do not hesitate to contact us should you want to know more about anything discussed in this podcast. CG Wealth Management is a division of Canaccord Genuity Corp., member of the Canadian Investor Protection Fund and Canadian Investment Regulatory Organization.